You know, for decades, the S&P 500 index fund has been the ultimate set-it-and-forget-it strategy for building wealth. I mean, it's simple, it's effective, and pretty much everyone agrees it's safe. But what if the rise of AI has planted a hidden risk right in the middle of this trusted investment? It really all comes down to a single, pretty shocking number.
40 cents. This one number is the key to understanding a massive, and I think potentially dangerous shift that's happening in the stock market right now. So what on earth does it mean?
Well, it means this. For every single dollar you put into a standard S&P 500 fund, a full 40 cents of it doesn't get spread out. Nope, it gets funneled into just 10 companies. I mean, look at this chart. It really shows you just how concentrated that is. We're putting a massive amount of faith and money into a very, very small group of companies. So yeah, this is what we're calling the 40-cent problem. Let's pull back the curtain and really unpack what's going on, and more importantly, why this is all happening right now.
Now, when you look at who these top 10 companies are, well, a pattern emerges pretty quickly. You've got all the big names, right? Nvidia, Microsoft, Apple, Google, Amazon. And if you just set aside Berkshire Hathaway and JP Morgan for a second, the rest of them share one huge critical trait. They are all spending an absolute fortune on artificial intelligence.
So why is this happening? How did we get here? Well, it all comes down to the plumbing of the fund itself. It's a market cap weighted index. And all that really means is the bigger and more valuable a company gets, the bigger its slice of your investment pie becomes, automatically. The system is literally designed to reward the winners.
And that simple mechanic creates a really powerful effect, especially with all the hype around AI right now. It's become a feedback loop where the biggest tech companies just keep getting bigger and bigger, pulling in more and more of our investment dollars along the way.
And this visualizes that cycle perfectly. It works like this. Big tech grows because of all the AI excitement. That growth then attracts more money from passive funds like your S&P 500. All that new money pushes their stock prices even higher, which in turn increases their share of the index, which, you guessed it, attracts even more money. It's a loop that just keeps feeding on itself.
And the scale of this whole thing is just staggering. I mean, according to Deutsche Bank, this AI spending spree isn't just boosting a few stocks, it's practically holding up the entire US economy. Think about that. Without it, we might already be in a recession. So here's the bottom line. Our safe investment is turning into a highly concentrated bet on a single technology. And whenever the market gets this top-heavy, it can create some serious instability. So how do we handle that risk?
Okay, the first step is to zoom out. Way out. To look beyond just the American market. It's so easy to get caught up in the moment and assume that the US will dominate forever, but history tells a very, very different story.
I love this analogy. Think of the global stock market as a cake. The size of the whole cake kind of stays the same, but who gets the biggest slice is always changing. If you go all the way back to 1900, the United Kingdom was the world's powerhouse. They had a massive 24% slice. Then fast forward to the late 80s, and it felt like Japan's economy was just unstoppable, that they would lead the world forever. And well, today, it's America's turn to have the biggest slice. The one constant is that leadership is never constant. It always changes.
And this is why diversifying is so incredibly powerful. A global fund doesn't force you to predict the future, it just adapts. If China or India or some other country starts to take the lead from the US, the fund automatically rebalances for you. It's built to roll with these huge long-term shifts in global economic power.
Okay, so beyond just spreading our bets geographically, we can also look for the opportunities that the rest of the crowd might be missing inside this whole AI revolution.
I like to think of the market in these 4 boxes, based on how big a company is and how expensive its stock is. In the top right, you have the crowded zone. That's your Nvidias and Metas. Everyone's already piled in. Then you've got your defensive zone and the super risky speculative zone. But the real opportunity, I think, is right here in the bottom left. The cheaper, smaller companies in the overlooked zone.
This really gets to the heart of the difference between the AI builders and the AI appliers. The builders are in an arms race, spending billions to create the absolute best AI model. But the appliers, those smaller overlooked companies, they can just use these incredible models at a low cost to solve actual real-world problems. You see, when a technology becomes cheap and easy to get, the real value often flows not to the people who built it, but to the people who figure out the smartest way to use it.
And finally, this kind of crazy, concentrated boom around a brand new technology, well, it doesn't just create opportunity. It also creates instability. So let's take a look at how the smart money, we're talking central banks, legendary investors, how they're preparing for what might come next.
Well, for starters, just look at this chart. This is China's gold reserves. For years and years, they were buying it at a steady pace, but just recently, that buying has gone completely vertical. Central banks all over the world are shifting into gold. Why? Because it's seen as a safe place to park money during uncertain times.
And it is not just central banks. One of the greatest investors of all time, Warren Buffett, is doing something very similar. He is aggressively building up his cash pile. It's just skyrocketing. He's a value guy, and right now, he's just not seeing many great deals out there. So he's keeping his powder dry, waiting for opportunities when things get a little cheaper.
So, what does this all mean for you? Well, when you put all these clues together, a much more balanced, much more resilient strategy starts to emerge. You don't just dump the S&P 500, but you build around it. You diversify with a global fund, you add some of those smaller AI appliers, you maybe allocate a small piece to a stable asset like gold, and you hold a bit more cash so you can jump on opportunities when they pop up. It's not about predicting the future, it's about preparing for it.
And that really leaves us with one final thought. In a world that's being completely remade by AI, is the biggest risk trying to guess exactly what's going to happen next? Or is it simply failing to prepare for a future that is, almost by definition, going to be uncertain?